Hi, it's John Kelly. In this module, we are going to discuss documentation, and in particular, the documentation of risk assessment procedures. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, before we talk about it, I'd like to talk about the two general documentation requirements, just to remind ourselves of those. There are specific requirements, which we'll come to in a second as they relate to risk assessment procedures, but the first general requirement is that an experienced professional should understand the nature, timing, and extent of the work you have done. And we remember that extent is less important than nature of the test. The results and the evidence obtained, and significant matters, if any. And in addition, we are to record some kind of identifying characteristics. We are to record who did the work and when, and who reviewed the work and when. Now, in terms of identifying characteristics, professional standards say, for instance, about purchase orders, that we may record a purchase order number. Now, may means the same thing as may not, so that's the same as standards saying if you're looking at a series of purchase orders, you may not choose to record the purchase order number. So that's an important thing to note. Second thing it says, among several, is it says if you plan to select journal entries over a certain amount, that perhaps all you need to document about what you're doing is that I selected a series of journal entries over a certain amount. And that's important. We're going to come back to that later as we talk about how we might document risk assessment procedures. Other hints about documentation: it is not necessary or practicable to document everything. That's 230A7. Notes that some matters documented are documented by other items. So, for instance, if you're looking to find documentation of audit planning in accordance with the standards on audit planning, the fact that an audit plan exists, that would document that you did all the things required by planning. The other thing it says is that each working paper does not need evidence of review. We said all working papers had to be reviewed and you had to document who did it and when, but you don't need to document that on each individual working paper. The other thing, and I sometimes see people say this, is, well, the reviewer is re-performing the audit, and that's what the documentation standard requires. It requires that there be enough documentation in the file for the reviewer to re-perform the audit. And that's not what standards say. Standards say it's a requirement for an experienced professional to understand what was done, which is quite different. Also, I think it's probably not possible to re-perform the audit. I think many people think they are. I think file reviewers often think that that's exactly what they're doing. But of course they're not, because they don't have access to the books of original entry. They don't have access to the documents. They don't have access to the files. So you are relying on what is recorded in the file. And I think sometimes people think they are re-performing the audit, but of course they're not. It just maybe they think they are. So the requirement is to understand, not to be able to re-perform. So, are we required to do risk assessment procedures? Yes, we are. Though if all we're doing is a risk assessment procedure, that provides no evidence. So 315.6 says we should ask about stuff. We should ask about fraud and error. We should talk to the client. It says we should do analytical procedures, and that's really, really important, because analytical procedures as risk assessment procedures have been proven to be really, really effective. So, by the way, is having a chat with the client about what's going on, having done some analytical procedures and said, oh, this is up and that's down. That's really, really effective. And observing. There's a list on A18 and it says perhaps you'd go on a plant tour. that kind of observation. 315.11 to 24 is about internal control, because that is a risk assessment procedure as well. And then the rest of the paragraphs are about identifying and assessing risk of material misstatement. Now, I said that analytical procedures done as risk assessment procedures probably do not provide any evidence, but you could extend or do further work on the analytical procedure to provide evidence, and that way you can get sort of double the effect, because you're doing an analytical procedure as a risk assessment procedure, and then you do it a little better and it becomes an analytical substantive procedure and provides evidence. So we need to remember that as well. And here's the documentation requirement in 315.12. We have to document our planning discussions, and we can do that by having an audit plan. That sort of demonstrates that we had planning discussions. We have to document our understanding of internal control, and that's beyond this module. We have to document the identified level of risk of material misstatement, and it has to be documented at the assertion level. And we have to document items requiring special consideration. And there's nothing specific on the documentation of risk assessment procedures, for instance, analytical procedures, other than the documentation of internal control, which is the second point on the slide. 330.28 has some other specific requirements. We have to document our overall response and the nature, timing, and extent of procedures. We have to document the linkage of procedures to risk of material misstatement and results and conclusions. So those are the general things we have to document. So how might we go about documenting the analytical procedures we do at risk assessment procedures? And here's a balance sheet. Cash down a bit, receivables and inventory down a bit, property, plant, and equipment about the same, bank loan up a lot, accounts payable down a bunch, long-term debt looks like it's down by the annual payment on principal, shares and equity haven't changed much. And we look at the income statement. Revenue, cost of sales are down. Amortization, interest on long-term debt are about the same. Administrative expenses, can we call those the same or not? I don't know. They're up by a bit. That's our income statement. So how might we document the analytical procedures we have done on these draft financial statements, draft information that the client's given us as we begin the audit, to do risk assessment procedures as one of the things we're going to do to identify the risk of material misstatement? So one of the things I suppose you could do, and I see people do this, they start with cash and receivables and inventory and they run their way through. And so, for instance, let's take it that this is what we have found documented in the file. Cash has decreased due to cash flow demands. Accounts receivable remained at 8% of sales. Inventory has declined because we bought less. Property, plant, and equipment additions similar to last year. Bank loan has increased because we paid suppliers. Accounts payable, the check run was done earlier this year. That's the reason for the change. Long-term debt decreased due to scheduled payments, so that's what we expected. No change to shares, and the change is income. Now, I guess the first thing I'd like you to do, and you've all had review notes on stuff like this, what kind of review notes are we going to generate from this? Probably going to get a review note of please provide a more detailed explanation, because due to cash flow demands is kind of a weak explanation. So please provide a better explanation of the change in cash. And really, because we have no expectation of what cash is going to be based on last year, that's going to be very difficult. So we're going to end up writing some more stuff because we got a review note. Accounts receivable has remained at 8% of sales. We're probably going to get a review note that says, please document why your expectation is 8% of sales. And we're starting to run into the developing of a substantive analytical procedure as opposed to a risk assessment procedure, analytical procedure. Inventory declined because less has been bought. We're probably going to get a review note again. That's a poor explanation. Additions similar to last year. That might get by. Bank loan increased to pay suppliers. Again, we're going to get a review note of some kind. Please provide a better explanation. Please explain in more detail. Analytical procedures. I like this one because a check run being done earlier this year argues for the opposite effect. So that explanation, I think, is clearly wrong. We're explaining the wrong change. Decrease due to scheduled payments. We're probably going to get some kind of review note of, I don't know, please provide a detailed list of what the scheduled payments are. And again, we're missing the point that this is supposed to be a risk assessment procedure, not a substantive analytical procedure. And some observations. There's really not much risk of material misstatement in cash. $200,000 or $300,000. We're going to take, I would expect, a substantive, largely substantive approach to auditing cash. We don't have much risk of material misstatement here, and that's just a really poor explanation. Observing that receivables have stayed at around 8% of sales, that actually would argue that there is no risk of material misstatement here. So really, we don't need to make any comment at all. We look at it and we go, ah, it looks about right. Inventory has declined because less is bought. Again, that's a bad explanation. We need a better explanation than that, I think. Property, plant, and equipment's additions similar to last year. Well, I think, again, that would just say, look, there's no particular risk of material misstatement that we've identified here. We looked at this year, we looked at last year, don't see anything. Bank loan, as I said before, that's a poor explanation. The explanation on accounts payable, that's just incorrect. So we need to provide something better there. That's just wrong. And the last three, it just says, well, really, there's no risk of material misstatement. Risk of material misstatement is not much above low. And so we're going to need to do the sort of the standard normal low level of audit procedures we do, but there's nothing special or significant that we need to worry about in our plan. Now, what kind of review notes are we going to get here? Revenue down from last year, cost of goods sold down from last year, everything else is similar to last year. And maybe I'm rushing ahead a bit, but just to say that revenue is down from last year, ask the client and they said revenue is down from last year. This is something that actually goes beyond the ability of an analytical procedure to give us an explanation. Yes, I see that revenue is down, but I'd really like to talk to the client and find out why. And if they say something like, well, we had a big contract with Walmart and it got canceled and took away $1 million of sales, that's why it's down. You might ask a couple of other questions. Well, has that made any of your inventory obsolete? And they say, no, we've had no problem with that. We knew it was coming. We wound down our inventory, so inventory is lower, cost of goods sold are lower. That explanation means that the change we see analytically makes great sense, and we understand what's going on. And we need to make sure that as we proceeded to the audit, as we find out other information, that explanation from the client is in fact a reasonable one. But that goes beyond our analytical risk assessment procedure, and we probably really need to record that someplace. Amortization, interest on long-term debt, yeah, they're all similar to last year. You're probably going to get a review note of some kind. And admin being similar to last year and repairs and maintenance similar to last year, I don't think either of those two things are correct. So let me just move on to the observations. Oh, I guess before I do that, I just want to say the way we've done this documentation, we're just begging for bunches and bunches of review notes to be written, none of which actually really relate to what we're doing, which is looking for risk of material misstatement in the financial statements. So let me go on to the next slide. Revenue down from last year, as I say, that's just a really poor explanation. We need a discussion with the client to understand it, and we need to be able to think about whether or not the client's explanation makes sense. Now, cost of goods sold are down in proportion to revenue, so that's actually good. Based on that analytical procedure and our understanding above, we probably can do some analytical substantive procedures, some control testing, and perhaps very limited substantive procedures on cost of goods sold. And amortization, interest, and interest on long-term debt, you know, those are absolutely in proportion to last year, and doing nothing other than a substantive analytical procedure might be all that's required for those three. Admin, again, I think we need to say to the client, like, what's going on? Why did admin expenses go up? What happened there? Are the others in proportion? Is it one expense that's changed? Don't know. If in the end we find that it's all in proportion except for one thing, I suppose we might examine that one thing, and then the rest we can do with analytical and perhaps some control testing. The repairs and maintenance suddenly being up, I'm going to say that that's an indicator, and maybe it's not, but I would, if I were doing this audit, I would say, okay, I think I've got a risk of material misstatement here because I think maybe some of this stuff could be capital. And so I want in my audit to look a little harder at repairs and maintenance than I otherwise would have done, because perhaps last year it was 100,000 last year, 100,000 the year before, 100,000 the year before, and we just said, oh, that looks about right, and not done anything specific. Suddenly we've got a $300,000 increase. That's borderline material. Has the client accidentally expensed something that should be capitalized? Don't know. I think we've identified a risk of material misstatement, and we kind of missed it. We called it similar to last year. So some observations on way number one. It's certainly a lot of work. It's certainly a lot of beautiful documentation that will all take a lot of time to do. Certainly gives lots of opportunity for someone to write a lot of review notes, and then for someone to spend a lot of time clearing those review notes. So that seems to be something of a lot of unnecessary work. The other thing is we've spent a lot of time documenting our risk assessment procedures, but what we were supposed to have been doing was documenting an assessment of risk of material misstatement by assertion, and we'd missed that. And if we'd done it right, we would have identified a risk of material misstatement with respect to repairs and maintenance, but we would have then identified it on a working paper, and we would not have hooked it to a response. So we would have had a risk identified that perhaps in the remainder of the audit we would not have addressed. So there's no linkage to our planned procedures from what we've identified, and no documentation of that. So we spend an awful lot of time documenting something that has no requirement to be documented, and have not documented any of the things that were to be documented. We also seem to have missed an obvious risk of material misstatement on repairs and maintenance. And it also seems we probably are going to get dragged into doing substantive analytical procedures and providing explanations of that, when all we're supposed to be doing is risk assessment procedures for the purpose of identifying risk of material misstatement. So here's my example of way number two, which is the way I would prefer to do it, where I would just say I compared this year to last year and noted any matters on the risk assessment form, which is a form I'll sort of show you in a minute. But that comes from 230A12, the example. And also I'm relying, if I've documented a risk of material misstatement based on analytical procedures I did, I guess I have implicitly documented that I did these risk assessment procedures, and it's implicit in the audit plan, and I rely on 230A7, which says that that's exactly what I can do. So here's what it might look like. Cash. I didn't note anything. I would probably not write anything down. I would say that in my opinion all assertions were of lower inherent risk, and I would then tell my staff that I plan to have a largely substantive approach to cash. Accounts receivable, it's going to depend, I guess, on the next line. It's the revenue line that's interesting, and I think here I would say, here I talked to whoever I talked to at the client, and they explained that the decline was as follows, And then based on what that explanation is, that's either a risk factor or it's not. And if it's not, I'm assuming that we had $1 million of sales to Walmart and we lost the contract and we have no obsolete inventory and we just moved on with lower sales. So if that's the case, all assertions are lower. Analytical testing seems from our risk assessment procedures that it's going to work really well. We'll do some control testing and minimal substantive testing. And that would also apply to accounts receivable. Inventory, assuming the story on inventory is the same as the story on revenue. Everything's low, analytical control and minimal substantive. Cost of sales, same thing. Accounts payable, they all seem consistent. When we add the three of those together, it seems about right. I would like a little bit more of an explanation of why that's okay, and I'd like to have some client discussion perhaps to see that that's okay. But again, presumably it's all low, and same intended approach. Same for administrative expenses. I think I said before, we need to know more about why administrative expenses are up. And if there's one particular expense that's up, analytical procedures, control testing, and then some testing on that one expense that's up might seem to be appropriate. Property, plant, and equipment, and amortization and repairs and maintenance. Here I'm going to move the assertion, I think, of occurrence up to high, maybe. There's been a significant increase. And so I want my staff to go and look at that. Go analyze repairs and maintenance and come back and tell me. Now, they might come back and say, you know, it's $400,000 worth of $100 items. There's nothing big in there. Or there's one $300,000 item and it either is or isn't capital. Or there's three $100,000 items and one is and two aren't, or whatever. But I think I'd like my audit plan to say, please go and look at that. And that then would also affect property, plant, and equipment, and amortization. Bank loan, long-term debt, interest on long-term debt and interest on long-term debt, analytical maybe only, very minimal substantive procedures. It all looks right. Bank loan, we're probably going to substantiate the balance, probably be able to do that in one item, get a copy of the bank statement, for instance, and the interest looks right analytically. So do a more extensive substantive analytical test, and that should be okay. And then shares, there's been no change. Equity, agree to the income for the change. So the other thing that we've found in particular missing from way number one, there was at least one risk of material misstatement factor, the repairs and maintenance thing, and maybe a couple of others that we needed to have talked about. We are required, one of the things that risk assessment procedures require is you need to ask about fraud and error, like the sales decline, what happened, accounts payable, why is it low, what's going on with the bank loan, is there a risk of material misstatement there, or can we, as we might be able to, realize that no, there's nothing going on. But you cannot do it all by analytical procedures. You're going to have to talk to the client and listen to their explanations and see if in the context of the very broad brush analytical procedures you've done, it all makes sense, or you think that perhaps there's a risk of material misstatement and you'd like some extra work to be done. So I like way 2 because it does what's needed. It does it by assertion. It links to risk of material misstatement and then eventually to nature, timing, and extent, because we've given some brief instructions to staff as to how they are to design the audit programs. A lot is documented implicitly. One of the requirements, 3510 on error and 304015 on fraud, says the partner is to communicate planning decisions to those who were not involved in the initial discussions, and we've certainly done that. So we've done far less work, spent less time, far less documentation in terms of less paper, but I think we've done the documentation that meets the standard. So, thanks for listening.